Good morning, everyone. Joe Mass here. It's June 15th. It's about 8:40 in the morning on West Coast time. As we're getting ready to talk about the markets today, the Fed has got a big announcement here. We're going to find out about how much they're going to raise rates and inflation and GDP. So we'll have an update here in just a little bit. As I'm recording this, the markets are all up right now. So we'll see if that holds throughout the day. So regardless of what the Fed does today, we're gonna talk about what's going on and we'll keep you updated. So let's dive in. You've seen this slide before. It's risk versus inflation, and the reason I want to start with it is it's again, this is the worst time in 30 years I've seen for investors' emotions, and so we realize that it's not the worst time for portfolio management, but for your tummy test and for knowing what you want to do, it's pretty muddy waters. So on one side of the coin, we have people that are more worried about managing risk. They're worried about the markets dropping, the geopolitical risk, all the events in the world. And so for those people, they would normally want to go into risk-off portfolios, which we have many to choose from, and use cash and bonds and risk-off assets. However, bonds aren't a good diversifier right now. They've been correlated with stocks. And when we have inflation as high as we do, those strategies provide real negative returns. On the other side of the coin, you have inflation. So if you really want to fight inflation, you have to accept and use risk, right? It's on the other side of the coin. So you have to use equities, value, energy, allocation, commodities, but you have to be on risk on assets to fight that. And so it's really scary and uncomfortable to be in risk on assets when the market is melting down, right? But we know that over the long term that equities are going to most likely going to prevail. That's what we believe, and they are going to provide a spread over fixed income and therefore give you a better chance to fight inflation. And so really the key is to figure out how much of each one of these portfolios or strategies do you want. Maybe you're 50-50, 50% of your portfolio is positioned to fight risk and 50% is positioned to fight inflation. So again, we'll talk about what to do in a few slides from now, but this is kind of the hedging your portfolio strategy that is probably going to prevail the best in these conditions. Okay, so with that, I just wanted to start off with that as a refresher. What drives the markets? Well, you've seen me talk about this before, and these factors are always factors that we're looking at, and sometimes, depending on where we're at in the economic cycle, that we're more concerned or less concerned with them. But right now, inflation is really the culprit of what we're talking about in the market slide. We're going to talk about the yield curve. We're going to talk about the Federal Reserve and their decisions and what they're going to be doing, the recession or a recession or the probability of a recession, and then corporate earnings. Okay, here we see inflation is measured by the Consumer Price Index, CPI, and you'll see that it, you've heard this in the news, that it hit an all-time high here, or a high in the last, 40 years, not all-time high maybe. You'll see that it's, 8.5%. So there's no doubt that inflation is here, and measured by the CPI, it is 8.5%. When we look at a different measure of inflation, we're going to look at the Fed's favorite, and that's the PCE. So the PCE is a personal consumption expenditure price index, and that's the gold line. It's 6.3%. This is a slide that we show you often. Then the white line is the University of Michigan 5-year inflation outlook, and the red line is the Fed's target. And as we've been talking about for quite some time, when the Fed is targeting 2% inflation and we've been running way below 2%, to get that to that average, we have to be above. Now, I don't think the Fed thought it was going to be 6 to 8%. It's not what they're looking for, and they're going to be fighting aggressively to bring that down, and we'll be talking about that. So we don't think it's probably going to stay 6. We're probably thinking it's going to be 3 to 5 in that range maybe, but it is high right now, and that's why the markets are in a bear market, is because they're worried about this inflation and the Fed's actions to fight inflation, which is raising rates and quantitative tightening instead of quantitative easing. On the blue line below, you see the unemployment rate, which it peaked during COVID. It came way down. It's very low. It's kind of flattened off, and it might start to come back up. Well, there's a lot of talk about companies laying off employees and getting ready for a recession. So, we may see that tick up, and we'll keep an eye on that. Okay, now we're going to look at interest rates or the yield curve. And the yield curve is, always a good insight to inflation, because if it's inverted, if long-term rates are lower than short-term rates, that inversion is usually an indicator that the economy is going to have a rough patch. So right now, it is still pretty steep and flat and positive sloping. We do have a small inversion between the 10 and the 20. The 10-year is lower than the 20-year. And you can see the different rates on the right-hand side there. So it's generally positively sloping. And, it flirted with an inversion a few weeks ago. It's flirting with inversion now. But what we'll be more concerned with is an inversion that lasts for months or quarters, right? That will be a much stronger indicator of what's to come than a small inversion. And we'll talk more about that in a few minutes. But right now, there are small inversions going on there. Again, you can see that in the 10 and the 5-year, where the 5 years higher than the 10, but it isn't in a full-blown inversion at this time. Turning to the Fed, here's the dot plot, right? This is the chart that shows where the FOMC members are going to vote to where they think dots are going to be, or where they're going to have the dots represent where they think interest rates are going to be, or where they're going to vote for interest rates. And of course, this is as of 3/16/22, and they're going to vote today. So we'll have a new dot plot chart here later today, tomorrow. But what's interesting here is that the kind of the blue line is what the Fed funds futures markets thought rates were going to be as of the last meeting, and the white line is the latest value. And so you can see that the market, as predicted by the futures market, is giving you an implied target rate of a little over 3.5% here by the end of 2023. So again, we believe that rates are probably going to come up higher. I think we need to bring up rates faster. You got to have rates coming up faster than inflation, and so normalizing rates isn't going to be bad for the long term. It's just it hurts when you rip that Band-Aid off. So again, I'd be happy to see rates coming up. Again, with rates on the 10-year now at 3%, you're actually getting yield from your bonds. So rates coming up is not necessarily a bad thing long term. It's just painful as we go through the transition. So continuing our talk on the Fed, over the next 3 meetings, the market is expecting 200 basis points of rate hikes. And the market sees the Fed front-loading hikes in today's FOMC meeting. So it's likely that we have a much more aggressive Fed than what's been expected. And I think that's appropriate, even though Powell said that he wasn't going to do 75 basis point increases. We need to get rates up to fight inflation. And so the market might even like it that the Fed is taking a more aggressive stance, which is kind of opposite of what you would think. But we do see the Dow Jones, S&P 500, NASDAQ, the S&P TSX composites. We do see most of the markets positive today. And that might be because they're hoping that the Fed, takes more aggressive measures to fight inflation. So we'll have to see how the market ends up after Powell speaks. But right now, as we're talking and recording, it's positive, and we do expect rate hikes to come a little faster than expected in the last meetings and earlier part of the year. Okay, let's talk about a recession. I mean, what is a recession? Who declares a recession? Well, the National Bureau of Economic Research, the NBER, is who declares the recession, and their definition is the NBER defines a recession as a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. Now, most of us who studied economics 10, 20, 30, 40, 50 years ago, we knew the definition of 2 quarters of negative or down GDP was kind of the old school version of a recession. This definition is the updated definition of a recession. And again, recessions follow bear markets. They don't lead them. And so by the time a recession gets here, if it does get here at all, the market may already be looking past that to recover. So again, we're right in the middle of the bear market. We're right in the middle of, at the beginning of the bear market, right in the middle of the down market. But if the recession does come, the market may look past that and start going up. So again, remember the recession lags and is called really after it started and ends. Sometimes, it's really hard to call a recession perfectly, as we're going to see in the next few slides. Okay, so I don't fear a recession. We're just going to manage through a recession, and we'll tell you kind of how to prepare for it, and we've been telling you how to prepare for it for quite some time. Okay. The probability, according to a Bloomberg article, is that right now it's about 30%. Okay, and that's up from the prior month, and so we'll show you kind of where these numbers come from. These survey numbers come from on the next slide. But right now, based on survey, it's around 30%. So where do those numbers come from? Well, this is just a survey that's done by Bloomberg, and they reach out to all the contributors, all the economists and banks out there, and you can see some here, AXA and Bank of the West and Barclays and Bloomberg Economics and Deutsche Bank and the econ forecaster. And this list is too long for me to show you, but they take all of these forecasters, right? And then they look at the statistics. So they look to see what's the range of forecasters. And so we have a range here of a low of 1. Okay, so there's a 1% probability there's a recession, all the way to the high of 100% that there's a recession, right? So nobody really knows, as evidenced here by the data. So the median is that 31.5. The mean, right? So the average is 31.1. And you can see where the votes have come in by these histograms here. Okay, so again, you got this one outlier out here at the 100, and we have one down as low as that 1%. So that's just where the recession might be. And when we look at the probability of a recession from the Federal Reserve Bank of New York's model, which uses the yield curve spread between the 10-year and the 3-month treasuries to predict it, you'll see that it's 3.7. Now, that's not the probability. This is just the number on the index. And so, as we saw in the prior slide with the yield curve, it's not inverted yet, and so or it's not doesn't have a strong inversion. So it's not a surprise that, based on the New York model here, that it's not having a stronger indication of a potential recession over the next 12 months. Now, you'll notice here these red bars are prior recessions, and so if this index gets to 40, you can kind of see that was really close to the number that indicated that recession. So right now we're at 3.7. Now this data, it's lagging a little bit, so it might be starting to come up, but based on this indicator, there's a very low probability of a recession. So again, we saw surveys that are from 1 to 100, and we're seeing a different model here at a low reading. Again, not a percentage, but just we want to get, if it got up to 40, that's looking like a recession. So who knows, right? I think a lot of people don't think it's going to happen this year. Some people do. Some people think we're going to avoid it. Some people think it's going to be next year. So again, nobody really knows. We don't know. And the market is reacting like there will be one, but the bond market isn't. So we'll show you what we're going to do and what we've been doing, and we're going to maintain course and speed, trying to manage both the fear of risk and the fear of inflation at the same time by having well-diversified portfolios. So now let's take a look at corporate earnings. Corporate earnings estimates, again, consensus estimates, look to give you about an 18.43% growth rate. So the current earnings are at 199. The 12-month forward-looking estimates are at 236.84. That gives you a growth rate of 18.43. And then if we look at the next year out, 249, so that's about a 5% growth, and then the year after that at 272, you look at that would be about a 9% growth rate. So they don't look bad; they're above historical averages. The thing that I worry about is that when analysts try to forecast the future earnings of a company, it's hard enough to do that under normal times, but when there's heightened risks and uncertainty in the market, it makes predicting the future harder, right? Predicting the future was already hard enough. Now it's really hard. So, as a CFA, as an analyst, when we're building financial models and we're forecasting, when we're making forecasts, it is sometimes very difficult to trust the data that we are forecasting. So again, we might see some earnings revisions to the downside, that's very, very possible. And so these numbers can change, and we'll be watching that. But right now, this is what the data is showing. Okay, so let's talk about what to do. We've showed you this slide before, and it really hasn't changed from the last time that we showed you. So what we believe you should do is communicate first and foremost, right? You need to let us know if if you're looking more towards fighting risk or more towards fighting inflation, or if you kind of want to take a balanced approach. We have all the portfolios to do that. So just reach out and let us know. The other thing that we want you to do is hold enough cash to make you comfortable, and there's not a right amount. Or one right amount. It's different for everybody. Somebody might want 2 years worth of cash. Look at your spending habits, right? Somebody might want 6 months. Somebody might want 3 months or a year. It's all up to you. Now, we're going to hold cash in the portfolios as appropriate per each portfolio's mandate. So what I'm talking about here is that I want you to think about if there's a cash goal that is personal to you that we need to overlay on top of the portfolios that we're managing. Okay, so again, evaluate your investment policy statement, all the factors, your ability and willingness to take risk, update your financial plan, look at your time horizon. And, right now you got to be patient. The next, few months, year might be very difficult and painful, but, 3, 4, 5 years down the road, we believe the equities will once again prevail over other asset classes. So you just have to be patient. Liquidity needs, again, look at the next 12 months and annual needs, and then hold that in cash. Evaluate your taxes, your legal issues, and then anything unique to your circumstances that we should know about. Illnesses, weddings, divorces, unfortunately, marriages on the bright side of the coin, a new roof, anything that that's unique to your situation that we might need to know about, so we can have a discussion about how to rebalance the portfolio. Just let us know. So what are we going to do? Well, we're going to maintain what we've been doing. Our processes aren't perfect, but they've been working pretty well. So we're happy with that. We're not going to try to overmanage. Again, each portfolio has a mandate. It's like a golf club. There's a driver, there's a putter, there's a 7-iron, right? So there's a hammer, there's a screwdriver, there's a saw. So we have different tools, and so we want to maintain the integrity of each portfolio. And so as we put those together, we'll know what we're building for you. Okay, we're always monitoring and adjusting. And we're really looking for reasonable risk-adjusted return opportunities over reasonable time periods. So we're not trying to outsmart the market. We're not market timers. We can't call the bottom. We can't call the top. We're just looking to be reasonable with our research and our adjustments to keep you on course. And so, again, we will continue to communicate. As a reminder, again, we cannot proactively change your risk profile or your risk tolerance since these are personally unique to each of you. Okay, so you must communicate with us if there's been a change in your situation, and you may want us to reevaluate your investment strategies. You don't have to worry about the portfolios at the strategy level. That's what me and my team take care of, and we're on that. But again, if there's anything coming from your tummy, you got to let us know. If you're more concerned with risk or more concerned with inflation, or you started the year off thinking that you could handle fighting risk, and now you're like, oh, maybe I can't, let's have a discussion. Okay, again, we just need to find the right balance for you. And many of you already are there, so you don't need to you don't need to communicate if it hasn't changed. It's just if something's changed, let us know. So with that, we'd like to say thank you. Hopefully you found this insightful. Again, call with any questions, and we really appreciate your trust. And we'll get through this, and we'll talk to you soon. Have a great day. Thank you.